A few years ago, I was like you. I was working, receiving money, but I was not investing. I was just saving the money. I was not actively investing. And that was harming me because if you are not investing your money, because inflation will eat up your money. It's important to realize that savings alone is not the best. Saving in your bank account, saving it on your Momo is not enough. The important thing is to just invest that amount of money you've saved. So saving is good, but investing is the best way to go. And today, I'm talking about beginner's guide to investing in Ghana. So if you are watching for the first time, understand that on this channel, we talk about money, relationships, and things that will make us better and live a better life in the future. So if you are watching, subscribe to receive notification whenever I upload a new video. You can as well like or share this video. Let's begin. Now, why do we talk about investment? I've already said that savings alone is not the best way to go. Saving your money in a bank account and sometimes earning 1% per annum, 2% per annum, maximum, sometimes 5 or 6 per annum is not the best. And so you invest because you don't want inflation to eat up your money and you want your future to be better financially. And that's why it's important for you to invest the money that you've saved. Don't just keep the money on your Momo account. Don't just keep the money in your bank account. The bank is benefiting whilst you are losing. So that's why we invest. Investment is for us to hedge against inflation. Very important you do that. You are investing because you want your money to grow. And that's the key thing. If you are planning to build a house, if you are planning to buy a car, you are planning to start a business, then you have to think about investing your money and not just saving it. Just invest it. For that money can grow for you to start that business, to build that house, to buy that car, to do whatever project you want to do. Now, before you jump into investment, you have to know yourself. Man, know thyself. It's important. Are you someone who loves risk? Are you someone who's afraid of risk? Some people are totally afraid of risk. Then you know what to do. We'll tell you what to do if you are somebody who doesn't like risk at all. If you are someone who loves risks in the investment world, the more risky, the better the returns. If risk is very low, the returns too are quite low, very low. So in the investment world, you must know yourself. Who are you in terms of risk? Know who you are before you start investing. Like me, I'm an average. I want to manage the risk very well. I'm not too high risk taker. I'm not too a low risk taker. So I balance it. But some are just low risk takers and some are very high risk takers. And then if you are that, you find yourself in these two groups. If you're a low risk taker, you talk about the kind of investment to make. If you're a high risk taker, you talk about the kind of investment to make. But the important thing is to know who you are. Know who you are, whether you're a risk taker or you hate risk. You don't like risk. And that is how it should be. You must know who you are first before you start investing. Now, let's look at some investment options in Ghana. It's important we know. So in Ghana, we have what we call the treasury bills. And this is for the low risk people who are not interested in high risk. They just want to go low. Government bonds and treasury bills are lower risk. Until recently, we knew that we knew that government bonds were not risk-free, but low risk. But that was just something that happened with the DDEP. And so that's the first time something of that sort happened in the world. And it's here. The previous government took us through that. But what is important is the treasury bill is lower risk. It's backed by government. And government normally does not default in its payment except what happened some few years ago, and we hope that will never happen. So we have the treasury bills and the government bonds. If you are a low risk taker, then you can jump into that bandwagon of T-bills and then government bonds. Another type of investment, the mutual funds and unit trusts. So for the unit trusts and mutual funds, professionals invest your money in stocks and bonds for you. What it means that when they pull money from various people put money together and it's invested on their behalf. So somebody does the investment for you, a professional, of course, who has learned the trade of investment. He or she does the investing for you. So mutual funds and unit trust are also there. That's a little higher. You get better interest than treasury bills. The good thing about the mutual funds and unit trust is that you can add money to it every now and then, every day or every month or every week, and put money into it, unlike treasury bills where you purchase for a fixed period. So if you buy a treasury bill for 91 days or 6 months or 1 year, it's fixed. You can't go and add 20 cedis to it or 30 cedis to it. But with the mutual funds and unit trust, you can add. You can add 20 cedis, you can add 10 cedis, you can add 50 cedis. So that is the difference. So if you are not going to get a lump sum any day, then start with the small monies and then use the mutual funds or the unit trust. We also have the stocks or the shares where you own a portion of a company. So when you buy a stock, when you buy MTN shares, you own some portion of MTN. And that is also another way of investment. And that's also a higher form of risk. So it's important to know the different kinds of risk. When you go into the stocks or shares, then when the company goes down, your shares also go, the value of your shares also goes down. When the value of the company goes up, the value of your shares also goes up. But in this space, you have to understand the company you are investing into. You have to learn, study, and know where you are investing your money. If you are going into stocks or shares, you have to do a lot of studies to understand the business you are investing in and whether to be profitable in some few years to come. Because if they lose, you're also losing. If they gain, you also gain. Now we also have the exchange traded funds, the ETFs. This in Ghana, we don't have ETFs. We don't have the companies that are put together. ETFs basically means, ETFs are companies that are put together. So stocks that are put together into one container. So when you buy an ETF, what it means is that when one company is going down and the other is going up, you don't lose that much. Unlike when you buy a single stock or buy a single a share in a company. When that company goes down, you lose because it's just a single one. But ETFs is a group of stocks that are put together. And so it's quite safer, even though you may also lose, the risk is higher. But compared with individual stocks, ETFs are better to go. In Ghana, we don't have, in our stock exchange market, we don't have ETFs there. But in the US market, we have ETFs. And if you like it, you can study it and then also buy some ETFs. We also have the real estate. That's another way to go with investment. But I advise that you must check the location where you are going to build that house. It's very important. Location plays a major role in real estate. Of course, if you want to invest in real estate where you don't actually build, but you invest in companies that are into real estate, that is also there. In Ghana, again, we don't have that as part of our stock exchange. I've not seen that yet, but in the US market, we have that. ETFs that are into real estate, we have stocks that are in real estate. So you have to consider. Of course, the risk too is higher. Like I said, if you're a risk taker, the stocks are high risk, ETFs are a little high, real estate are high risk. But of course, the interest, the profit too, are higher compared with the lower risk like the treasury bills and government bonds. So you have to look at the two, but they are real estate too is there. If you are interested, you can go in to that sector too. But the important thing is you don't need huge money to start. I remember one of my investments, I started with 20 cedis. You can start with 100 cedis, you can start with 50 cedis. Some you can even start with 1 cedi. So you don't need huge sums of money to start investing. And that is something you must understand. If you're a student, you can start. If you're a professional, you can start. So, but don't delay. When you hear the gospel, there's a financial gospel, just quickly jump into it and start. The amount, like I said, doesn't really matter. The important thing is to form the habit of investing. Another important thing is to invest in things you understand. Don't invest in things that are shady. And sometimes they promise you big interest. So you invest 1,000 and in 3 months you get 10,000. It's a dangerous venture. Invest in things that you understand. And of course, do your homework well. Read, watch videos, understand what you are investing in. Understand the company that is keeping your money very well before you go in there. Don't just throw your money in there and it's not registered. It's not a registered business with the Exchange Commission of Ghana. It's going to, when they vanish, you may not know who to report to. So do your homework well before you start investing. So this is just the beginner's guide to investing. If you are a young person, if you're a professional and you want to start investing, consider these. But know your goals. What are you investing for? The long term or the short term? Know what you are doing and then make sure that you understand where you are going. If you have enjoyed this video, please subscribe to receive notification when I upload a new video. You can as well like or share this video. God bless you.